Okay, welcome. A very good morning, afternoon, or evening from the FP Markets team. Thanks so much for joining us today. We've a reasonably good turnout with some regulars here and also some newer faces. So for those of you who don't know me, my name's Aaron Hill and I work with FP Markets in their research department. In my 12 years at the charts, I feel I've accumulated sufficient experience to help newer traders build a basic foundation and develop, which is what I hope to achieve today. I'm also currently in the final stages of completing my CMT designation, which, as I'm sure you can imagine, is time consuming. Before I begin the presentation, I'm hoping we can all see the welcome slide and also hear me loud and clear. Let me just check the questions before we kick off. If you can just type in yes or no if everything's coming across loud and clear, that would be fantastic. So also look, as a highlight, excellent, thanks guys. So look, as a highlight in every webinar, a recording of this presentation will be available through a number of avenues. The easiest way to locate the previous webinar recordings is through the FP Markets website. Just check for resources on the upper menu of the web page, the main web page, and under the education column, you'll find the webinars tab. Just give me a second, guys. Otherwise, you can also check out the FP Markets YouTube channel or wait for FP support to send an email on how to view the recording shortly after the live session ends. Just give me a second. Okay. So, as usual, guys, let me just quickly run through the disclaimer on screen. The information contained in this material is intended for general advice only. It does not take into account your investment objectives, financial situation, or particular needs. FP Markets has made every effort to ensure the accuracy of the information as at the date of publication. FP Markets does not give any warranty to or representation. Does not give it any warranty or representation as to the accuracy, reliability, or completeness of the information contained in the material. So the essentials of the disclaimer is really there to highlight that anything discussed here is not investment advice, it's simply educational. And as always, I recommend doing your own research in anything trading and investing, as ultimately it's you who pulls the trading trigger. Okay, moving swiftly on. As you can see, we have a number of topics to get through in today's session, kicking off with an introduction to chart patterns. We'll then move on to flag and pennant formations, then on to wedge configurations, and then on to the head and shoulders pattern, and finally we'll touch on triangles. And if time, good day guys. And if time, I may be able to touch on double tops and bottoms, as I know these are widely followed patterns too. And then finally, a Q&A. But, you know, in all likelihood, I'll cover most of the questions as we move along. One thing I will highlight at this point is everything I show is what I consider textbook, meaning the patterns identification standards and measures are taken from well-known authors. However, I know from experience that traders adapt pattern arrangements to suit their trading methodology, which is absolutely fine, as trading, at least in my experience, is a subjective art. So whenever I switch from what I believe to be textbook to my own personal views, I'll try to remember to underline this as we go. Also, please feel free to share your views on the patterns shown. One other thing worth pointing out is that although we all keep our own records of pattern success rates, a gentleman by the name of Thomas Bukowski has done considerable work on this, so be sure to check him out. He runs a website called the Pattern Site and also has a book titled a Visual Guide to Chart Patterns. If memory serves me correct, his work states that a tight bullish flag and the head and shoulders top are some of the best performing patterns. And look, these tests are not small tests he did. I believe they cover something like 3,000 examples. And these two patterns we'll cover shortly. So without further ado, let's get things underway. So look, the terms pattern and formation are often used interchangeably, which is something I'm also guilty of. I also sometimes use the word configuration as well. Right, what are chart patterns, and are they a means of successfully navigating markets on a consistent basis? That's the question we all want to know, right? So depending on who you ask, each answer will be slightly different, depending on their experience level within the markets. I'm sure most of us have heard that patterns don't exist on charts, that price is random and has no structure. This is largely the opinion of many academics, as far as I'm aware. On the other side of the coin, though, we have dedicated technical analysts who completely push aside this notion that patterns do not exist. One trader in particular is Linda Rushka. I do hope I pronounced her surname correctly. Nevertheless, she has traded short-term patterns for years with a good track record, so do consider checking out her work on her website. I believe the main chunk of her traded markets are with stocks and futures. So really, guys, for me, I found patterns do form in the markets, and these, as far as my understanding goes, are formed on the back of traders' emotions. This is not only down to my personal experiences, but also traders I'm in contact with who use pattern structure to generate trading decisions. But ultimately, it is down to you to decide and prove for yourself whether patterns are, shall we say, real or not. What I mean by this is you will need to conduct thorough backtesting to prove this. And I'm not referring to 10 trade examples. You should ideally target much more than this, which encompasses all market environments. Now, I've read some traders accept 20 to 30 trade examples in a backtest, which I have followed in the past. I guess if you're trading the daily time frame, this may be sufficient. But for me, especially on the lower time frames, I would want at least 50 to 100 on each pattern. These are trade examples, likely more in order to catch as many trading environments as possible. What I mean by trading environments is trending markets and ranging markets, so the uptrends and the downtrends and the ranges that form. Excuse me, guys. So I've also been told on a number of occasions that it's not the technical patterns that generally causes failure in this business. It is the trader. Chart patterns present themselves and tend to offer similar, characteristics to the preceding patterns that developed. But the outcome will be random, which remains a difficult piece of the puzzle for many traders to understand. However, over a series of trades, there is usually predictability. This is where thinking in probabilities comes in handy for those interested in dipping their toe in the world of trading psychology. We held a presentation on this some time back, which is available on the main FP Markets webpage or alternatively through our YouTube channel. One final point, which may be obvious to those in the markets for a while, is patterns are formed by way of horizontal and ascending lines. For any newer traders confused by this, hopefully in the next 30 or 40 minutes, this will become a lot clearer. Just give me a second, guys. Right, so on the first slide, we have what's known as flag and pennant patterns. Now, I'm sure you guys have seen other traders use flag and pennant patterns in forums and across social media channels. And, likely for good reason. These formations are considered high probability patterns and offer, in my experience, offer frequent opportunity. Flags and pennants, as you can see, are similar chart patterns offering relatively short-term structure. The majority of textbooks I've come across state that these patterns are generally shorter than 3 weeks in duration. However, myself and other traders do employ these patterns on much shorter time periods, like the H4, the H1, and the M30, M15, and with some traders, scalpers, the M5 and M1. I think the majority of textbook definitions assume most trade the daily time frames and higher. But again, guys, feel free to test this for yourself and prove whether these formations are, shall we say, a fit for you on the lower time frames. As you can see from the slide, both flags and pennants rest upon what's known as a pole. For the flag, it's named flagpole, but this is really nothing to be concerned about. The key thing to note is the patterns are accompanied by a distinct pole. So what's a pole? Well, a pole is essentially a strong run, either higher for a bullish arrangement or lower for a bullish scenario. So with the bullish flag, we have a pole facing upwards, and for a bullish pennant, similarly facing upwards. For a bearish flag, the flagpole is facing to the downside, with the bearish pennant also facing to the downside. We have one question. I'm just going to note where I was so I don't get lost. Okay, why is a bullish flag considered bullish? It felt like it's a higher low and a lower high. Michelle, can I get to that in a few seconds? I'll ask questions at the end of this slide, and I'll try and address that. So look, back to the pole. This is an important yet an overlooked element. I see a lot of traders highlighting bearish flags and bullish, pennants and flags on charts without taking into consideration the arrangement of the pole. Do not disregard this point. In fact, a good method to begin looking for these patterns on the charts is to start by locating the flagpole first. So another point to take on board is that flags and pennants should look proportional to the height of the flagpole. So ask yourself whether the flag is too big or too small. So in the examples here, you know, with the bullish and bearish pennants, this is what I would call an ideal situation. This looks proportional to the formations. With the bullish and bearish flags, they look a touch large, so they should have really been a bit smaller. But proportional, you know, they have to be proportional to the flag. So the flag pole and the flag construction has to be proportional. So yeah, as I said, ask yourself whether the flag is too big or too small for the flagpole. So for flags, the pattern's makeup is simply formed by way of two reasonably parallel ascending or descending lines with at least two contact points required on either side. Other traders, however, may require more tests to confirm the flag. So what I mean by this is there are two parallel descending lines to form the bullish flag, and conversely with the bearish flag, two ascending lines to form the bearish flag. For pennants, we look for two converging ascending and descending lines, and as you can see on this slide, it forms a tight triangle pattern. I generally look for tight formations, as I found that these offer the better performance. How far do we want these patterns to retrace against the prevailing trend? Now, this for me is a good question, because you want some objective way of measuring how far we should let the pattern's formation correct or pull back into the prevailing trend, right? So for me, I sometimes use the 38.2% fib retracement as a guide. So what I mean by this is from the top of the flagpole, I would measure from point A to point B, and then the Fibonacci retracement levels would extend as such. And I would always look for at least, I would look for around a 38.2%, sometimes even the 50% is fine for me. But ideally, I would look for the 38.2% around that area to determine a pullback or a correction. So importantly, flags and pennants can essentially slope in either direction, yet most common we will see pattern structure lean against the price trend, and this is what I tend to only focus on. These patterns are typically viewed as continuation patterns within a prevailing trend. As also for traders who use volume studies, Those who trade in futures and stocks, for example, may want to note that volume tends to decline as the pattern forms, though a spike in volume can sometimes be seen at the breakout of the pattern. And the breakout of the pattern is at these points here, and here, and here, and here. So if it's okay with you guys, I'm just going to touch on volume for a minute, because I had a few questions come through on the emails regarding this, because I've mentioned it a couple of times, so I'm just going to briefly touch on this. So absent of a primary exchange and clearinghouse, measuring real-time FX volume is, it's impossible. Unlike other financial markets, such as stock markets and futures markets and options markets, the foreign exchange market is decentralized, often referred to as what's known as an over-the-counter market. OTC is an off-exchange transaction between two parties. Consequently, volume data on most MetaTrader 4 and MetaTrader 5 platforms, which I'm sure most of us are using, are broker-fed. The trading activity of the broker's clients and not that of the entire FX market. As you can imagine, this causes different volume readings across different brokers, across different FX brokers. So look, in the stock market, volume is a measure of how many shares have been traded. In the futures market, volume is calculated by the number of contracts sold. As I'm sure you can imagine, the Forex is different. Although retail traders would expect volume to represent the number of lots traded, the majority of CFD and Forex brokers actually display what's known as tick volume. And this measures the number of price changes, price moves up and down. So look, sorry for diverging somewhat. Let's head back to these patterns. So one final note on the flag and pennant patterns is the take profit target. The price target for both patterns is sometimes called the measured rule. You'll note this if you've read some technical analysis textbooks. This is what they tend to call a measure form. This is what the measured rule is. What a lot of traders use from textbooks, and this involves taking the distance from the beginning of the flagpole and extending this value from the breakout point. Also, traders tend to enter on the breakout candles with protective stops positioned around these points and these points and these points. Let me just go over that quickly. So for the measured rule, the bullish flag would be taken the distance from the bottom of the flagpole to the top where the first retracement forms. This is then extended from the breakout point, and likewise for the bullish pennant, bearish flag, and bearish pennant. Now, guys, I'm sure you can spot the mistake I've made on this slide. I did not extend the length of the flagpole from the breakout point, so apologies for this. If I've caused confusion, let me know, and I will go over this part again, no problem. But yeah, as for stops, so traders would look, as for entries, traders would look around these points here, and these points here, and this point at this point. But for stops, generally, I've seen traders attempt to place stops above the bearish flag and below the bearish flag for the bullish scenario. Yes, so look, any questions on this, please do fire them across. So look, one other point worth acknowledging is flags and pennants are also known as half-staff patterns, or sometimes called half-mast patterns, meaning they sometimes appear midway in a price trend. You can therefore project the price where the trend could end. Guys, like everything in technical analysis, this does not always work, of course, but flags and pennants are handy when you need to help determine a trend's lifetime. Look, guys, any questions on the flags and pennant patterns? Oh, yeah, we did have one. Yeah, sorry, Michelle. So look, why is a bullish flag considered bullish? It felt like it's lower low and lower high. So the higher low, and so we have So a bullish flag for me it will form within an uptrend, so it would be considered a bullish continuation formation, especially on the breakout. So we're looking for break. So look, also there's another point. So once the breakout forms here, some traders prefer to see the breakout form above the previous higher high here as an additional confirmation to confirm the trend that we're currently in. I hope that answers your question, Michelle. I'm sorry if I've misunderstood. Yeah, so look, as time is of the essence, and we still have quite a lot to get through, let me spin things over to wedge patterns, and we'll try to keep this section a little shorter. So I'm guessing some of us going by this slide are wondering what the difference is between wedge patterns and pennant formations. The key difference for me is, unlike a pennant pattern, a sharp move preceding the wedge is not required. Another point is the wedge patterns tend to be more of a longer term pattern, whereas a pennant is, as I've said already, is considered more shorter term. Thomas Bukowski, the gentleman I mentioned at the beginning, actually states on his website that the wedge pattern's duration is a minimum 3 weeks. Otherwise, it's a pennant. Okay, we've got a few more questions coming through. Will you go to the current charts to find some or showcase some? Yes, if there's time, Daniel, I will head over to the charts. I have them uploaded already. It's just that we have quite a lot to get through, and ultimately I want to deliver as much information as I can today, so you walk away with something you can work with. Another question: does the flag and pennant patterns require a strong preceding trend? That's a good question, Angelo. For me, the flagpole has to be a defined movement. Let me just go back to the slide. That's okay. Whoops. Let me explain it better then. So for me, I would say yes, Angelo. I would need a strong preceding trend. Strong is obviously relative, but I would need a decisive trend to form. But look, the key thing to remember with these patterns is the flagpole. There are some statistics on how aggressive these flagpoles are, and relative to the breakout performance. So, and this is available on Thomas Bukowski's website, I believe. So do check that out. But yes, the answer to that question, Angelo, is yes. I would require a notable trend to form. But also do take into consideration that you must have a flagpole to identify the bullish flags and flags and pennants. Okay, no worries, Angelo. One more question: how to predict whether tendency for bullish, how to predict whether tendency for bullish or bearish pennant? I don't think there's any way of predicting these. As I said at the beginning, you need to. For me, I would always look for the flagpole to form first, then find a type formation forming. It's only on the breakout, really, guys, that you can actually know that you've got a valid flag or a valid pennant. Any time before that, you don't know what's going to happen. Price could continue lower and simply drop. Right? We just don't know. So there's no way to actually predict whether we have a flag or a pennant, unless only once we have the breakout in play. Also, guys, just as a quick one while I'm here, a lot of traders will enter on the breakout, as I've said, but some traders will require additional confirmation, and I'm one of them traders. So I require at least a retracement, which I think from a textbook is called a throwback. So a throwback to this line with subsequent upside, and the same here. After we've broken to the downside, a pullback to the breached bearish flag would be what I'll be looking for. And you can also drill down to the lower time frames and even look for candlestick confirmation within this point here as well. Okay, I hope that answers your questions, guys. Let's move back to the wedge. I'll just repeat some of what I've said, just in case you guys have forgot this, because I've just gone back to the flags and pennant. So as I said, there is a difference between wedge patterns and pennant formations. The key difference, as I believe I've already said, is unlike a pennant pattern, a sharp move is required. Is a sharp move preceding the wedge is not required, as I've said. So another point, as I think I've already touched on, the wedge tends to be more of a longer term formation, whereas as I've already said, the pennant and the pennant pattern tends to be more shorter term in nature. Look, so Bukowski also underlines the pattern requires 5 points of contact to be valid. Now, here Bukowski's identification standards come through extensive tests, more than 3,000 tests. So there's certainly something to take into consideration when looking for wedge patterns. That is 3 points at the trend line and at least 2 points at the opposing channel line. Actually, I think many experienced traders simply see the wedge as more of a channel. Look, so what I mean by 3 tests for the pattern trend line is at this point, and at this point, and the opposing trend line at this point, and at this point. So we basically need at least 2 points at the opposing channel line and 3 at the pattern trend line. Look, wedges are also a pattern that can form. This may confuse a lot of traders, but wedges are also a pattern that can form in the shape of a consolidation against the prevailing trend, and also as topping and bottoming patterns, i.e. reversal structure. Again, guys, remember, we do not require a pole to precede the wedge formation. So look, for example, here we have a rising wedge formed within an uptrend, and buyers are clearly beginning to lose steam. This allows traders to apply the opposing channel line above the rising trend line, right? Because as buyers begin to lose steam, less of higher highs are formed, and so the opposing channel line can be applied. This brings me to a vital point: the trend line, the lower ascending line, should always have a steeper slope than the opposing channel. Oops. So the pattern trend line should always have a steeper slope than the opposing channel line. Otherwise, I do not see how it can be considered a wedge formation. Once or indeed if price breaks beneath the trend line, as in the form of the rising wedge, so a close forms beneath the line, there is, unfortunately, as far as I've found, not a textbook price target. As for protective stops, many traders look above the opposing channel line. So this will be this higher high here, essentially, as logical stop loss placement. Though again, you know, if a supply or a resistance base is present around this area, that it could be worth taking this into account as well. I certainly would. As I said, there are no measuring techniques for the price targets, but I have seen, however, many will take the base of the pattern's length, which is extended from this point to this point. So we just draw a vertical line from this point to this point and extend that from the breakout point. Or the breakout candle, should I say. But look, guys, as I've already said, we have to use our charting experience here too. We cannot, just because a pattern's rules of engagement state that this is that this or that take profit is accepted. If we're trading into SR, support or resistance, we have to adapt, right? This goes for any pattern. We always have to keep the surrounding chart structure in mind, although we're trading patterns with defined rules of engagement. And this is a key point to be mindful of. So this pattern tends to be accompanied with diminished volume for anyone that's interested. So look, I hope this has been of use to you guys. I'm trying to get as much information as I can across it as I can. If you feel that I'm going too fast, let me know and I'll try and slow it down. Alternatively, you can of course watch the recordings and send me any questions to my FP Markets email, which I'll put across in the chat box for anything you're unclear of. So I have a question here. Do you look at the wedge pattern only on the daily chart or H4 chart if it's a long-term pattern? Daniel, I would probably look on mostly on the daily chart, but I have seen wedge patterns form on the H4 chart as well. I tend not to go any lower than H4, as I know from textbooks it's more of a longer-term pattern. But as I've said, I have seen traders do this on the H1, M30, sometimes even the M5 chart, 5-minute charts. But yeah, for me, I tend to stick at the H4 daily charts, even the weekly and monthly charts as well. It's something to keep in mind. I hope that answers your question. Okay, look. So I'll now switch things over to a pattern I'm sure we're all reasonably familiar with, the head and shoulders pattern. So as I've said, this is probably one of the most well-known chart patterns today, with the likes of Bukowski stating its statistical significance as one of the better performing patterns, with more than 50% of the time price reaching its price target, if memory serves me correct. And this was done, as I've said previously, over nearly 3,000 trade examples. The head and shoulders top pattern and bottom patterns are relatively complex, and it can be confusing for some newer traders. Hopefully, I can be of help here, though. So look, just as a quick heads up as well, the head and shoulders bottom is actually usually called an inverted head and shoulders, just in case you see some other traders mentioning it by that name. Now, the head and shoulders is considered reversal structure, which means it, shall we say, forecasts points on the chart, on the chart a preceding up or down move may reverse. It does not necessarily have to form within a monstrous uptrend or up or down trend. It could simply form within a retracement or a pullback within a prevailing trend and mark an entry into that trend to buy a dip or sell rallies. So this pattern consists of, as you can probably see on the slide, this pattern consists of 3 defined peaks for a top and 3 defined bottoms for an inverted configuration. The first peak in a top is called a left shoulder, followed by a subsequent higher high, which is the head, and then another right shoulder forms following this. Note the pullback. Note the pullback to form the right shoulder does not break the recently formed head. This is crucial to understand, guys, as it would invalidate the pattern's structure. So let me just repeat that. So the pullback to form the right shoulder at this point here should not exceed the formation of the head here at this point there. And the same goes for the inverted head and shoulders pattern as well. So look, although not often seen on the charts, as I'm sure any head and shoulders traders will acknowledge, the two shoulders are best seen at approximately equal levels. Now, of course, this does not have to be perfection here, guys. Just be aware of this point. I also, so what I mean by this is I tend to look for the left shoulder and right shoulder aligning. But as I said, this is trading, guys, and nothing is seldom perfect. So I want to see them within reasonable range of each other. Let's put it that way. I don't like to see a right shoulder right up at this point and a left shoulder down here. It just doesn't look symmetrical in my opinion. So another feature worth underlining is what's known as a oh, sorry guys, I also look for symmetry to form with the two shoulders. What I mean by that is so both should emphasize either a wide or narrow presence. So if they're pointed, I want to see both emphasize that sort of presence. So another point worth underlining is what's known as a complex head and shoulders top or bottom for that matter. Now, in these scenarios, these include patterns with, for example, 2 left shoulders at this point here. So we have 2 left shoulders formed here with 1 right shoulder, or alternatively 2 right shoulders and 1 left shoulder. Some complex patterns also have a double head formation here. Despite being a variation, the basic characteristics of the pattern remain the same. So when the head and shoulders top is spotted and a neckline is broken, it usually signifies the currency pair, assuming we're talking about the FX market here, is headed lower. And this brings me nicely on to the subject of the neckline. So the neckline for a top is drawn across the bottom troughs that align either side of the head. So the troughs here at this point and at this point. So we join the neckline from this point to this point and extend it out to the future. When or, indeed if price breaks through the neckline after forming the right shoulder, of course, it indicates the confirmation of the head and shoulders top. For top formations, it's best to see the neckline either in an ascending position or a horizontal position. While for an inverted example, I would always look for a horizontal example, a horizontal line joined from the peaks that surround the head, or a descending version. Why that is, you will see now. You will hopefully see now. So the entry trigger for a head and shoulders is a close beneath or above the neckline. Some traders may opt to wait. So when I say that, so a close beneath this neckline here, so price comes down and closes below the neckline drawn from these points here, and the same at this point here. So we have a close above the neckline here. Some traders may opt to wait for additional confirmation in the form of a retest, and all this means is a pullback for the top formation that tests the neckline. Now, I'm sure anyone that's followed head and shoulders for any length of time will note that this does occur. So a pullback is simply, so for anyone that's been in the market for any time, as I said, so it's similar to a support and resistance, right? A support, when a support is broken, when a resistance is broken, it tends to offer support if retested, and the same goes for this one. So if a support's broken here, it tends to offer resistance if retested. That's really all that there is to it. Some traders take it a step further and look for additional candlestick confirmation to form on the retest of the neckline. As for the pattern's price target, the textbook approach is to measure the height from the head to the neckline in a vertical fashion, and quite simply add this to the breakout price. Now, what do I mean by this? So we have the head of the formation and we have the neckline position down here. So all we do is take the measurement or the value between the head and the neckline and extend this from the breakout point or the breakout candle. Okay, and the same goes for this one. We take the distance between the head and the neckline and extend this whole value to the breakout point or the breakout candle. Okay, so I hope that's clear. As for volume, this tends to be highest on the rise into the left shoulder, and then as far as I've seen it, subsequently decreases throughout the formation. Though I'm sure most of us would appreciate higher volume on the breakout beyond the neckline. Okay, guys, any questions on head and shoulders? It's pretty empty at the moment, the chat box. Okay, it looks like we're all good. Okay, so swiftly moving on to triangle patterns. Now, a number of pattern structures fall under the umbrella of triangles, including standard triangles, so i.e. symmetrical triangles, ascending and descending triangles. The wedge and pattern formations are also are also triangle formations, which we've already looked at. The broadening pattern, which is similar to, so imagine a funnel or a megaphone. So prices, I haven't touched on this because I'm going to focus on these three patterns: the symmetrical triangle and ascending triangle and descending triangle. But for a broadening or a megaphone pattern, we tend to see price work with so diverging trend lines. But this can be very, very difficult to trade, guys, and I don't see a lot of people having success with this unless it's combined with something that's known as a diamond pattern. Now, if you're interested in the diamond pattern, it's quite a rare pattern to see on the charts, but according to Bukowski, it has the highest percentage of success in patterns, as far as I remember. So a diamond pattern is essentially a broadening formation formed here. I'm not sure if I can add the drawing tools. 1 second, guys. Let me see. Oh yeah, so we have a broadening pattern here. So we have price joining between these. Now, as you can imagine, guys, this is very difficult to trade, right? Because where would you place your stop unless you were using price action, so support or resistance, because you'll be looking for the breakout above or below. But with the diamond, you're looking for the combination of a broadening formation and a symmetrical triangle, which we're going to touch on here. So price comes like that, and then if it's a top, it usually breaks out, hopefully breaks out to the downside and can have considerable, offer considerable gains. Let me just see if I can get rid of this now. Yes, okay. Okay. So as I've said, the main focus of this this slide is the symmetrical triangle, the ascending and descending triangles. So let's kick things off with what's known as a symmetrical triangle. Now, look, although you would expect this formation to have symmetrical sides, as you can see, as it's drawn here, it really does, and that's why many textbooks also label this formation as a coil, as price essentially, it coils within the converging trend lines. Within the pattern, price must also touch the lines at least twice. This is a textbook standard, similar to what you would need with a traditional trend line to, shall we say, activate its presence. We also want to see price cover the triangle space. Now, what I mean by that is, and let me just point out, guys, that although textbooks require 2 points, I've seen a number of traders require at least 3 points, and that goes for the trend line as well. So it's not a fixed measurement, in my opinion. So as I just said, within the pattern, price action must touch at least twice, and we also want to see price cover the triangle space. I looked for at least. So what do I mean by covering the triangle space? So in this instance here, we have there's no space, there's no white space. But ultimately, we do not want to see any white space formed. So we have a symmetrical triangle formed here. What I don't want to see, or what the textbooks say, I don't want to see this, okay? Although I've seen some traders draw it like this, we don't want to see the white space. We want to see tight configurations, okay? This is something to look for. And this goes for the pennant formation and the flag formation as well. We don't want to see white space forming within these areas. I hope that's clear, guys. So I look for at least 60 to 90% of the space covered. So around this point here to be covered completely, okay? With price action gyrating between the two converging trend lines. Let me just delete that. Okay, right. Yeah, and I think I've read from the Edwards and McGee book of technical analysis. This is a must-read for many that's interested in technicals, by the way. That most breakouts of the coil triangle occur at around 75%. So we're looking at around these areas here. Okay. 75% of their formation to the apex. So the apex is this area here, and this is what's known as the base. Though, it's important to note that false or sometimes called premature breakouts are common, so be sure to have some filter if you're considering these patterns to determine breakouts. Yeah, we have a comment, only about 400 pages to read on that book. Yeah, the Edwards and McGee, that's actually the Edwards and McGee book of technical analysis is actually, there's a lot of pages taken, there's a lot of information taken from that, and they've put it into the CMT program. So you can imagine for the CMT, as I've said in previous webinars, for the CMT level 1 is 700 pages. For the CMT levels 2 and 3, it's over 900 pages of in-depth. It really goes in depth on the technicals of of the market and things like that. So I mean, as I've said before, if you guys are interested in the CMT program, do certainly look it up. It certainly opens your eyes to how broad and diverse this the technical community really is. Yeah, it certainly does keep you busy for a while, Daniel. It certainly does. As I said at the beginning of the webinar, it's very, very time consuming. When I say time consuming, I'm talking 4 to 5 hours a day of study. Because my exam is now in December, I've tried to get a head start because the exams are given twice a year. June, which I've missed. Sorry, I've not missed. I think they're on the 15th of June, but the next one is in mid-December. So yeah, guys, do check that out, the CMT, or failing that, consider purchasing the Edwards and McGee technical analysis book. It really opens your eyes to how much there is involved in this in the technical world. So look, as for volume on these patterns, as I'm sure you can imagine, it tends to decline as we form these patterns. But on the breakout, I like to see some higher volume form. Let me just delete this, guys. Sorry about that. Yeah, we have a comment. So the breakout direction is guaranteed as shown here. No. The breakout, nothing is guaranteed in technical analysis, right? Nothing is guaranteed. If you give me a minute, I'm going to get onto that very shortly, as this pattern is a neutral pattern. This pattern tends to be focused to the upside. However, it can form as reversal structure. The descending triangle, as you can imagine, generally breaks out to the downside, but also can form as reversal structure as well. We have a comment from Daniel. If you read that one, is that covering most of level 1? Not really, Daniel. No. If you're referring to the CMT level 1 book, it isn't. No. There's so much into that. I mean, look, guys, if you're interested, do check out the CMT level 1. It really isn't easy. Do not think because you understand charts or you understand the basic patterns, that's all you need. That's what I went in with, and I was. As you can imagine, I was shocked, to say the least, of how much work is involved. And there is I think it's like a 60% pass rate for levels 1 and 2. I'm not sure about 3. I think it's the same, 60%. But yeah, so good luck with that if you do go for that. So where am I? As I've said, textbooks show we should buy or sell on higher volume. Again, though, look, some traders prefer to wait for a pullback to form at these points here. Sorry, that's a retracement. The same here, a retracement to form before taking a position in the market. As you can probably guess by now, the symmetrical triangle is a consolidation chart pattern that occurs when when price action trades sideways. It is considered to be a neutral pattern. I say this purely from experience, guys, and through my study over the years. Symmetrical triangles are, for me, the epitome of confusion. Price does not know which way to trend. Most symmetrical triangles should be longer than 3 weeks to help distinguish them from pennants. Sorry. Again, guys, this is textbook stuff. The exception, of course, is when a pennant is missing a flagpole, right? So in this case, the pennant is really a small symmetrical triangle, as we can see here, without the flagpole. But look, guys, I know we will be looking at these patterns on the lower time frames that will not reach the 3-week characteristic. Therefore, attention should be paid mainly to the flagpole. So if a triangle lacks a pole, it's likely to be a wedge configuration or a symmetrical triangle. Okay, on to ascending and descending triangle patterns. Let me just remove this artwork. So look, as you can see, ascending triangles are wedge-shaped patterns that break out most often to the upside. The triangle can act as a reversal or continuation of the existing price trend. For this information, we look for this formation, we look for a defined resistance level at this point here, in the company of an ascending line at this point here, and the points tend to these two lines tend to merge at as they're projected forward. While we also we also require at least 2 tests for this formation to be considered valid. However, as I've noted, some traders will require more tests than this before they commit to the pattern. A descending triangle is also considered a wedge-shaped pattern that breaks out downward most often. So look, similar to the ascending version, it can serve as a reversal. When I say reversal, I'm talking about this area here, or as it's drawn on the chart, a continuation within the current trend. To locate this formation, we look for horizontal support to form, okay, that receives at least 2 tests, and a descending line to accompany this structure, which, as I said, with the ascending triangle, that converges if projected forward. Again, to textbooks, volume in this pattern tends to recede and can be especially low on the day before the breakout. Price must cross the pattern from side to side. I'm sure this is pretty obvious for you guys, filling the triangle with movement. So look, as I said before, I tend to try and avoid patterns with excessive white space, as I already explained, in the center of the triangle. Again, for anyone that's was confused by that, what I mean by this is I don't want to see price doing this, okay, and then leaving gaps. Excuse my artwork, guys. I don't want to see this. What I want to see is that. So it covers the white space, okay? So there's little white space seen. In terms of entry and stop placement, entry is typically taken on the breakout of the triangle formation. Though like most breakouts, many traders command additional confirmation. Traders will also look behind the breakout as a place to consider plotting stop loss orders, though I would again recommend including surrounding structure. Now, let me just erase these drawings just real quick and I'll show you what I mean. So for a short position entered here, traders tend to look at these points here, and likewise, so a long entered here, traders tend to look at these points here. Now, again, guys, as I've said throughout this presentation, I would always recommend looking at surrounding price structure, not just placing your stop willy-nilly behind the ascending lines and descending lines, and the same goes for the symmetrical triangle as well. So if there's a support level at this point here, placing your stop here would be, would be dangerous, in my opinion, would be open you up to an unnecessary loss, right? Because price could simply come down, test the support, and off it goes. So always look at surrounding structure, place your stops beneath the surrounding structure. Okay, as for price targets, textbooks quite simply calculate the base distance. When I say base distance, I'm talking about this area here, and extend this from the breakout point. The same goes for the ascending triangle and descending triangle. Okay, That's simply that, or from the breakout candle, as I've said throughout the webinar. Let me just. Okay, next on the side. Okay, Q&A. Okay, we do have a couple of questions that's come through. The top line is horizontal for ascending triangle. Let me just go back to the slide. Whoops. So the top line is horizontal for an ascending triangle. Yes. Yes, it is. Yes, Quan, I think that's your name. So yes, the ascending triangle is we have a horizontal resistance level, and that's just see the question. Top line is horizontal for, yeah, the top line is horizontal for both ascending and descending triangles. The only difference is the ascending triangle is a resistance and the descending triangle is a support. Okay, and the ascending triangle is the ascending triangle's resistance is accompanied by a ascending line, and the descending triangle support is accompanied by a descending line. I hope that answers your question. Okay, could you please treat, whoa, a few questions coming through now. Could you please comment on, in regards to volume accompanying these patterns? Yes, look, in regards to volume, just remember the only difference, as far as I can see, of all these patterns, aside from the head and shoulders, top and bottom patterns, volume tends to recede within the structure. That's all you need to look at. And for the breakout, we tend to look for higher volume, right? But for the head and shoulders, top or bottom, we generally see high volume coming into the left shoulder, and then as the formation subsequently forms, volume tends to decrease. Again, on the breakout, I would always like to see higher volume. Okay, I hope that answers your question. Could you please, another question, could you please treat top and bottom? I don't think I have enough time to go over the top and bottom patterns. Next question. Give me a second, guys. Can directions of the breakout of the ascending and descending triangle go reverse? Yes, Angelo, it certainly can. As I said, an ascending triangle and descending triangle, although commonly for an ascending triangle, the breakout is to the upside, and for a descending triangle, the breakout is to the downside. However, they can form as reversal structure as well. So what I mean by this is we have the downtrend forming, the descending triangle forms at this point here, and we get a breakout to the upside. How do we know if they're reversal or continuation patterns? We don't until the breakout forms, right? If we get a breakout to the downside, we know we potentially have a continuation pattern on the cards. And likewise for the ascending triangle, if we get a breakout to the upside. Again, we just don't know until the breakout forms, right? So once the breakout forms, it will tell us, price action is telling us which way price is likely to head for. Another question, 1 second. I mean, can ascending breakout? So, okay, Angelo, I think that answered your question, I hope. So another question, if you had to rank the patterns in how often they occur in your experience, how would you rank them in your experience? Right, for me personally, the flags and pennants are very, very common, as I'm sure any trader that's been in the markets for a while will attest to. The wedge formations are less common, in my opinion, because they're more longer term, right, and they tend to require much more price action to go in between the walls of the formation. But yeah, for me, the bullish and bearish, the flags and pennant patterns are the most common that I've seen, and they're one of the better patterns in my opinion to trade. But look, guys, when I say, I'm certainly not saying go and trade these patterns in isolation, right? Always look at surrounding structure. This doesn't only go for the stop loss placement. This goes for entry as well. So, for instance, if you have, let me just get the pen on real quick. So, if you have a you have to excuse my artwork here, guys. So we have a flag pattern form here, okay? Nice looking flag, reasonably nice looking. And we have a breakout to the upside, okay? Now, if this pattern was forming in reaction to a resistance, okay, I'll just leave that as a RES, resistance, all right? So price had touched this resistance here, and now we're forming a bullish flag here. What could be a bullish flag? And we get a breakout to the upside. What's the chances of price breaking above this resistance? Of course, it could occur, right? But for me, if this is occurring, this pattern warrants additional attention, if that makes sense. So for me, I would not trade on the breakout at this point. Taking into consideration we have a resistance here, I would always wait for price to clear this resistance at this point here and retest that level. I hope you guys can see that. So always take into consideration the chart structure, the psychology of the charts, look, you could also say trend line. So another example could be a trend line resistance break, right? So we've broken, so we're coming down, testing the downward trend line, and we break out. Now, if we form a bullish flag pattern, excuse the drawing, guys, at this point here, and we know we've broken a downward facing trend line, we know we not only have price action on our side with the break of the downward facing trend line, we also have a breakout to the upside of a bullish flag. I hope that makes sense, guys. I have one more question. Where do you think is the minimum? 1 second. Where do you think is the minimum time frame to use these on? I typically trade 5-minute time frame on swing trades. Just need one leg of price action. Okay, so if you trade typically on the 5-minute time frame on swing trades, Jared, when you say you trade the 5-minute time frame for swing trades, do you mean you look for the 5-minute time frame to locate entry and use the higher time frames, the swing trades, the swing price movement in conjunction? I'm not sure quite what you mean. If you could just, okay, you do. Okay, excellent. Yeah, look for me, that's a perfect way of looking at these. So, for instance, if this is a good example here. If we have the bullish flag pattern forming here, but we know we have higher time frame resistance, and we break above that, we know we're pretty much good to go, right? We have higher time frame convergence as well. Even better would be if we break the resistance line down at this point here, right? If there's resistance here, price breaks up, then forms the bullish flag and then rallies to the upside. That's even more confirmation, right? So we not only have we got a retest of the resistance that was here, turn support, we also have a bullish flag confirming that, or not confirming, helping you confirm, especially after the breakout to the upside. And we also, with these, as I said, with these bullish flags, we also have a price target to focus on. Okay, I hope that answers your question, Jared. So one more question we have, what time frames are applicable, relevant, significant as regards to all patterns shown today? Now, for me, guys, I always trade for anyone that follows my daily analysis, I always focus on the monthly, the daily, the H4 and H1 time frames. So for me, that is what I look at. I can't really comment on the lower time frames, though I have seen them form on the lower time frames. Most of my work is done on the H1 time frame and higher. I have traded the lower time frames before, but not using pattern structure, mainly with the psychology of charts, which hopefully in the future I will conduct a presentation on, but it's quite an in-depth subject, and I think it will require more than one webinar to help newer traders understand. Okay. So a triangle and triangle and flags are continuation patterns, while wedge patterns are no. So the wedge patterns can be either reversal patterns or continuation patterns. The main thing with the flags and the pennants is to look for the flag pole. It has to be a decisive movement, right? It has to be a decisive movement either side of the flag or pennant. That would identify whether you have a pennant or flag in play. Without the flagpole in play, you're dealing with something potentially like a symmetrical triangle or a wedge. Right, so guys, I think, let me just erase these drawings. I think that's all the slides. All right, so look, unfortunately, it appears we've run out of time. Look, as I've not had much time to cover the psychology of these patterns, which I did hope I could go through, and there was no time for any chart work. Yes, Daniel, do you think it would be worth revisiting this? And I can go into detail on the charts and also the psychology of the patterns. And I can also try and include some chart structure that can help define, help place your chart pattern within the overall context of the market you're trading. If you would like a part 2, let me know, and we can get that sorted as soon as possible. What I'll do is I'll review the material we've gone over, and then I'll hit the charts as quickly as possible so we can get more of a understanding, more of a deeper understanding. Yeah, okay, guys, excellent. So look, also be sure to register for next week's webinar with my colleague Isaac on advanced trade management on Tuesday, and I think you're back again with me on Thursday, where I look at the different financial markets. Well, we have an important question here. Do you still keep a diary as a trader? 100%, Daniel. A trading journal, 100%, and that is so important for anyone starting out. Keep a journal, because how do you know what your strengths and weaknesses are without a diary of your emotions during the trade, your strategies you're using, the markets you're looking at? Look, that's 100%. You should keep a diary on anything. Any tips on backtesting patterns? Yes, Angelo. For backtesting, I'm not sure if any of you guys have heard, but you can purchase the Forex tester. I've had that for years now. The Forex tester backtesting, I think it's relatively cheap. I think it's $200. I'm not sure now, but it's helped me. Considerably to understand the patterns and where they're most likely to form. So the break of resistance, a bullish flag pattern above that, gives me a lot of confidence now. So also do bear in mind when you say backtesting, with this we're trading what's known as a partial discretionary system, right? Which means the pattern provides you with a structure to focus on, and it's down to the trader whether he or she takes that pattern. This is called a partial discretionary system, which, as I'm sure you can imagine, includes some psychological elements to it. So a backtest is never going to be 100% unless you're testing a non-discretionary system, which is based on mathematical formulas. Maybe in the future you can show us how to diary on trades. Yes, I'll do that. That could be a webinar on its own, really, because there's so much you can talk about with that. And also, I think there's been presentations on Trading Plan. It should have been covered within that as well, albeit briefly, maybe. Okay, look, so yeah, as I said, be sure to register for any of the future webinars coming up. As I said, I'm back with you guys on Thursday, where I look at different financial markets, and Isaac's with you on Tuesday for advanced trade management. So look, guys, thank you very much for your time. I really appreciate it. I hope you've left with some more information. And as I said, guys, my email's in the chat box. Yeah, as I said, if you have any more questions, you can always reach me at marketanalyst@fpmarkets.com. Do ask me any questions you have, and I'll get back to you as soon as I possibly can. All right, guys, and that will help clear up any confusion you have through this presentation, because as I know, I've thrown a lot of you guys for this, because I want to get out as much as I could across to you. So, okay, have a lovely day, and I'll see you all again very, very soon. Bye.